Chapter 5 Financial Relations General. One of the most important aspects of center-state relations concerns finance, which is required by the states for many purposes: administration, police, social service, economic progress, etc. The constitutional division of powers and functions requires that the center and the states should have independent financial resources for the performance of their functions. According to Professor Rare, quote, both general and regional governments must each have under its own independent control financial resources sufficient to perform its exclusive functions, unquote. Financial autonomy of the center and the states is vital to the preservation of the federal principle. It's therefore as necessary that the state governments should be able to command the means of supplying their wants as that of the national government should possess the like faculty in respect of the wants of the union. Freedom and elasticity in the field of finance are of the utmost importance to make readjustments to suit the changing circumstances of a country's development. The principle of independence and its concomitant responsibility may, therefore, be regarded as the first important principle of federal finance. As Professor Adarkar points out, quote, the cardinal principles to be followed in financial settlements is that, as far as practicable, the federal government and the states should be endowed with independent sources of revenue free from mutual interference, and that the balancing factors should come in only marginally so as to fill up the gaps, unquote. Adequacy and elasticity are both essential elements of federal finance. Adequacy implies sufficient resources for the center and the states in order to maintain certain standards of administration and perform fiscal functions in their own spheres. Elasticity implies the expansion of resources in response to the growing needs of the government concerned. The practical effect of the division of financial resources has been the increasing reliance of the states on the center. The main reasons for increasing dependence are: 1. The resources for raising funds available to the states are comparatively inelastic and inadequate. 2. The functions allocated to the states involve expanding responsibilities, particularly in the context of ambitious development plans and consequently increasing expenditure. 3. Important sources for national plan financing are foreign aid and deficit financing, both tending to strengthen central rather than state resources. Dependence of the unit on the federal government should not be too much, as it will water down the autonomy of the states, and it will also encourage the growth of irresponsibility in state administration. A federal structure implies two sets of governments, autonomous in their spheres. These must accept responsibility for discharging their respective functions and exercise their powers. If centralization makes the states more and more dependent on the federal government, a federation might end up by becoming a unitary state. The two sets of governments must be allocated powers responding adequately to the increasing needs of their functions. The following observations of the study team appointed by the Administrative Reforms Commission to go into center-state relationships are apposite. Quote, in the states, excessive dependence on the center tends to produce irresponsibility and operational inefficiency. At the center, dominant financial power in relation to the states gives central authorities exaggerated notions of their importance and knowledge, and does not allow sufficient place to the points of view of the states. It's important, therefore, that the degree of financial dependence of the states on the center should be reduced to the minimum, because that minimum would be adequate from the point of view of giving the center controlling powers in the context of ensuring national integration. Unquote, page number 23, volume 1. The allocation of finances made by the Constitution between the center and the states has given rise to two main complaints. One, constitutional division of finance is not fair to the states. And two, in the distribution of the taxes collected on behalf of the states, and also in the matter of discretionary grants by the Union to the states, there is scope for discriminatory treatment. Though the states are in charge of most of the welfare activities, their sources of raising funds are comparatively inadequate. They are to depend on the center for grants or overdrafts. This chronic indebtedness and dependence on the center's charity gradually make the states ineffective, and they develop a tendency not to take any responsibility but to throw the blame on the center for their defaults. It's very doubtful if the financial implications of a developing society were realized when the Constitution was made. It's clear now, in retrospect, that ampler resources should have been placed to the disposal of the states instead of making them so dependent on grants and loans from the center, grants and loans which they seem to be able to extract from the center under irresistible political pressure, while for the purpose of achieving balanced regional development, it's very necessary that the center retain a distributable pool of resources. The correction of the imbalance between the states' aspirations and resources calls for an amendment of the relevant articles of Constitution so as to vest in the states more adequate source of finance to match their developmental needs and aspirations. Responsibility for development and the power to discharge it would then be better matched, and recourse to grants from the center would be rendered largely unnecessary, thus enabling the center to reserve their use to the more justifiable case of contingent assistance. Court, recognizing that the needs of the states increasingly outstrip their resources and that funds have to be developed by the center in some form or other, it's only realistic to grant the case for extending the base of devolution and bring other taxes also within the ambit of shareability. This will also enable rationalization in tax levy and administration. Unquote, report of the study team appointed by the Administrative Reforms Commission, pages 41 and 42 of volume 1. The taxes which the Union could levy are specified in the entries 82 to 92A of the Union list, and those leviable by the states are specified in entries 45 to 63 of the state list. Entry 44 of the concurrent list refers to stamp duties other than judicial stamps, but not including rates of stamp duty. 3 items of taxation specified in the Union list are meant for the exclusive use of the Union. They are: 1. Duties of customs including export duties, entry 83; 2. Corporation tax, entry 85; and 3. Taxes on the capital value of the assets exclusive of agricultural land of individual and companies. Taxes on the capital of companies, entry 86. Of the remaining heads of taxation leviable by the Union, taxes on non-agricultural income have to be distributed between the Union and the states. Duties of excise on goods such as tobacco, which are not compulsorily distributable between the Union and the states, may, if Parliament by law so provides, be shared by the Union with the states. This, in fact, is so far being shared by the Union with the states on the basis of the recommendations of the finance commissions. When dealing with the distribution of legislative powers of taxation, we had occasion to notice that the power of levying excise duties on medicinal and toilet preparations containing alcohol, etc., under 84 of the Union list was under the 1935 Act vested in the units. Similarly, the units had the exclusive power to levy taxes on transactions in stock exchanges and futures markets, on the sale of purchase of newspapers and advertisements published therein, and on the sale of purchase of goods in the course of interstate trade or commerce, and all these levies have now been included in entries 90, 92 and 92A of the Union list. We will presently deal with these four entries. It is a salutary principle of federal finance that a statutory devolution of resources on the states, more or less automatic and not based on the discretion of the center, is essential for the preservation of state autonomy, as it would considerably reduce, if not remove altogether, financial dependence on the center. The necessity for expanding the area of assured devolution has been recognized by the Administrative Reforms Commission study team. The following extract from their report throws much light on this aspect. Quote, financial assistance flows from the center to the states in the main through two channels. One is the channel of what might be called assured devolutions, where the states are not left in any kind of doubt about what they are going to get, and their share goes to them regardless of what they spend it on and how they perform. In this class fall divisible taxes and grants and aid under Article 275. One of the features of this sector of assured devolutions is that the amounts are determined on the basis of a semi-judicial adjudgment by the Finance Commission. The other channel is where executive and discretionary factors operate, and while the amounts transferred to the states are large, their actual quantum remains uncertain and subject to year-to-year fluctuations. Plan grants fall in this category. A valid method of decreasing the dependence of the states on the center would be to see that the states get more through assured devolutions. Unquote, page 24, volume 1. Quote, we are of the view that the base of devolution should be widened by including more central taxes in the list of shareable taxes. Unquote, page number 38, volume 1. Quote, as pointed out earlier, a method has to be devised of expanding the area of assured devolutions, more particularly if the proposed rearrangement of functions between the finance and the planning commissions is not to operate to the detriment of the states. Successive finance commissions have recommended progressively larger devolutions of taxes to the states in view of their expanding range of functions, particularly in the economic field. Nevertheless, all except a few states continue to need grants and aid to fill their non-planned revenue deficits. It therefore appears necessary, 1. to secure for the states a larger devolution of taxes than at present, so that in actual practice the need for grants and aid under Article 275 either disappears or is minimized. This would suggest A. widening the base of devolution, and B. fixing the state's share of divisible taxes at sufficiently high levels. 2. To bring about a fuller exploitation of the assigned taxes mentioned in Article 216(9) of the Constitution, and 3. to safeguard the interests of the states in the matter of such of the central taxes as concern them, and to have an institutional forum for consultations between the center and the states to facilitate an appreciation of common problems. Unquote. Quote again, one way of reducing the excessive dependence of the states is by increasing devolutions. The normal essential expenditures of states have been increasing and will continue to do so at a fast rate. It will therefore have to be examined whether there is not a case for widening the base of devolution by extending shareability to other taxes. Unquote, page 41 of volume 1. Taxes exclusively appropriated by the Union, corporation tax. We may first consider the items of taxation, the proceeds whereof are wholly appropriated by the centre, namely duties of customs including export duties, corporation tax and wealth tax. In the report of the Union Constitution Committee, dated the 4th of July 1947, the proposal was that customs, export duties and taxes on companies should, in addition to some other items, be levied and, if necessary, be distributed. In the Memorandum on the Indian Constitution as adopted by the Constituent Assembly in July 1947, this provision was reproduced. The memorandum was considered by the Constituent Assembly on the 30th of July 1947. Consideration of this provision was postponed as suggested by Sir N. Gopalaswamy Iyengar, who stated that it was intended to appoint an expert committee to undertake a detailed investigation into the whole question of distribution of revenues between the Union and the federating units. In the draft constitution prepared by the constitutional advisor, Sir B. N. Rao, in October 1947, provision was made for the optional sharing by the centre with the units of export duties. In the meantime, an expert committee was appointed as suggested by Sir N. Gopalaswamy Iyengar. The then provinces, in their representations to the expert committee, urged the provincialization of some of the central taxes and inclusion of more central items of revenue in the divisible pool, as well as enlargement of their share in the taxes which were divisible under the 1935 Act. Madras was one of the provinces which urged that corporation tax and export duties should be included in the divisible pool. The expert committee submitted its report in December 1947. In paragraph 38 of its report, the expert committee suggested that the units should be assigned a portion of the net proceeds of the corporation tax also. But the committee did not favor the division of the proceeds of customs, export duties, and taxes on the capital value of assets. The drafting committee did not accept the recommendation of the expert committee regarding corporation tax. Members of the Constituent Assembly sent a number of amendments to the provisions contained in the scheme of financial relations between the central government and the units. Thiruvalargal K. Santhanam, M. Ananthasayanam Iyengar, T. A. Ramalingam Chettiar, and B. Gopala Reddy, the then finance minister of this state, and Tirumadi Durgabai suggested amendments so as to provide that the proceeds of the corporation tax also should be shared. The draft financial provisions were discussed in great detail at a conference of the premiers, that is, chief ministers, in July 1949. At the conference, the then finance minister of Madras desired that corporation tax should also be included in the divisible pool. This suggestion was opposed by Thiru K.C. Niyogi on the ground that the corporation tax was never intended to be shared between the centre and the provinces under the 1935 Act. The question again cropped up when the provisions were considered by the Constituent Assembly in August 1949. Thiru B. Das urged that the corporation tax also should be shared by the Union with the states. It will thus be seen that from the very beginning, persistent demand has been made, particularly by the representatives of this state, that the corporation tax should be made divisible between the Union and the states. It's interesting to note that the Joint Parliamentary Committee, in considering the levy of the corporation tax, suggested that the corporation tax should be extended to the then Indian states after 10 years from the date of formation of the Federation, a right being given to any state to pay to the central government an equivalent lump sum contribution and empowering the Indian state itself to impose the corporation tax. This was a special concession suggested by the Joint Parliamentary Committee in the then prevailing situation. All the states have been complaining about the exclusion of the corporation tax from the divisible pool. They have been pressing their demands before the finance commissions for the inclusion of the corporation tax in the tax on income. The Third Financial Commission has stated all the states have pointed out that as a result of a change brought about in the Income Tax Act by the Finance Act of 1959, the income tax paid by companies is now classified as corporation tax and is thus excluded from the pool of income tax hitherto available for distribution, and that the states have represented that, quote, this has deprived them of an expanding source of revenue to which they had hitherto a constitutional entitlement, unquote. The Third Commission made it clear to the state governments that the recommendations which the Commission would make should necessarily be in consonance with the provisions of the Constitution and the terms of reference. The demand was again pressed before the Fourth Finance Commission. It was represented by the states that what the framers of the Constitution had intended to be a flexible and expanding source of revenue to the states had ceased to have the significance that was once contemplated. It was also represented to the Commission that while the collections from corporation tax had increased by well over 600% in the course of 12 years, the corresponding growth in the divisible pool of income tax was less than 50%. The Fourth Commission pointed out, quote, due note should also be taken of the state's representation about the need for abating, in some measure, the loss sustained by them consequent upon the reclassification of income tax paid by companies, unquote. The matter was again raised by the states before the Fifth Commission. Some of the states suggested that the net proceeds to be divided between the Union and the states should include a part or the whole of the proceeds of corporation tax. The Fifth Commission disposed of this contention of the states by inviting attention to the increased share allotted to the states by the Third and the Fourth Commissions, and stated that no further increase in the states' share on this ground only was necessary. Under one of the terms of reference to the Fifth Commission, it was required to make recommendations regarding the problem of unauthorized overdrafts of certain states with the Reserve Bank of India. While dealing with this problem, the Fifth Commission again adverted to the sharing of the corporation tax. Some of the state governments represented to the Commission that the inadequacy of their resources has been accentuated by the unilateral action taken by the central government, which has deprived them of their legitimate share out of proceeds from income tax on companies. The Fifth Commission, while admitting that the classification of income tax paid by the companies as corporation tax has resulted in contradiction of the divisible pool, has stated that the central government gave the states a compensatory grant to make good the loss. It has again invited attention to the increased share of income tax fixed by the Third and Fourth Commissions. It will thus be seen that the states have been agitating for a long time for the division of the proceeds from the corporation tax between the Union and the states. Thiru Amal Roy, in his article entitled Federalism and Planning in India, Their Mutual Impact, in Volume 3, Number 4, October-December 1969, of the Journal of Constitutional and Parliamentary Studies, has stated that it is necessary to bring corporation tax into the divisible pool through a suitable amendment of the Constitution. He points out that the increase in income arising from the progress of developmental planning will largely be in the corporate sector of the economy, that the plan is a joint national enterprise in which the center and the states are partners, and that therefore both of them have equally the claim to fruits of development. Thiru A.K. Chanda says, quote, "The yield of corporation tax has now outstripped that of income tax, including surcharges of approximately 110 million rupees, grossing respectively 2,220 millions and 2,180 millions of rupees. The super profit tax is expected to yield another 200 millions of rupees. In other words, leaving aside taxes like wealth and gift tax, the taxes on income are expected to yield a net of over 4,000 millions of rupees a year, of which 1,680 millions of rupees only will form the divisible pool. No wonder, therefore, that the states cast a covetous eye on the yield of taxes on incomes and adduce various arguments to bring within the purview of distribution excluded items." Unquote. Quote again, a reclassification of income tax in 1961 had also transferred income tax on companies to corporation tax, adding to the revenues of the center, eroding the divisible pool. As expected, this has been a matter of bitter complaint by the states, some going to the extent of suggesting that it was a violation of the relevant constitutional provision. This, of course, was a puerile plea rejected out of hand by the successive finance commissions. Unquote. Again, Thiru G.S. Bhattacharya, speaking at the Indian Parliamentary Association Symposium on Center-States Relations, held in New Delhi on the 3rd of May 1970, has urged that the corporation tax also should be made compulsorily divisible. According to him, under the existing social system, it's the corporations or companies which are becoming more and more dominant in our economy, and if taxes on companies are left out of the state's sphere and are assigned exclusively to the center, the states are rendered all the more weak. The revenue derived from corporation tax has outstripped the revenue derived from the levy of tax on income of individuals. It is the corporate sector which contributes a substantial portion to receipts under the Income Tax Act. In pith and substance, the corporation tax is a tax on income. This will be clear from the definition of the term corporation tax in Article 366(6). The definition begins by saying that it means any tax on income and specifies the other requisites. Our suggestion is not that the entire corporation tax should be allocated to the states, nor that this item should be transferred to the state list. What we recommend is that the corporation tax also should be treated on the same footing as income tax. Our recommendation on this point finds support in the report of the study team of the Administrative Reforms Commission. The study team has suggested that it will have to be considered whether the corporation tax should not be shared with the states, and that the question of sharing corporation tax will have to be viewed in the light of the exclusion from the divisible pool of income tax paid by companies. The study team has recommended the setting up of an expert body to examine this question, and as one of the possible items for examination by such an expert body, the study team has suggested the sharing with the states of the net proceeds of income tax paid by companies. Customs, including export duties. Customs and export duties are levied not on the articles as such. The occasion for the levy is the movement of the articles, that is, import or export. It may be that the basis of levy is the valuation of the article concerned, but the point to be noted is that the incidence is on the transaction. The customs and export duties are similar to excise duties. Excise duties are now distributable, though not compulsorily, and successive finance commissions have determined the share of the various excise duties. Under Section 141 of the Government of India Act 1935, export duties, although levied by the Federation, were divisible among the centre and the units if a central act so provided. But as already pointed out by us earlier on, the Export Committee appointed by the Constituent Assembly to consider the financial provisions to be incorporated in the Constitution expressed itself against sharing of export duties. At one stage, the drafting committee agreed with this view of the Export Committee. At a subsequent stage, the drafting committee itself proposed an amendment providing that export duties should be divisible if Parliament so provides. It was pointed out that the amendment was meant to rectify an omission, since the article was intended to follow the then existing provision contained in Section 141 of the 1935 Act. But the Finance Ministry took a contrary view, holding that export duties should be excluded from the divisible pool. At the conference of the premiers convened by the drafting committee, the Premier of Uttar Pradesh and the then Finance Minister of Madras pleaded for the continuance of the position as it then obtained under the 1935 Act, whereby the export duties could be distributed among the units if the federal legislature so desired. The Premier of Assam went a step further and demanded that the sharing of export duties should be made obligatory. However, Thiru K.C. Niyogi and the Central Ministry of Finance expressed their opposition to the suggestion. The discussion was wound up with the observation that general consensus of opinion seemed to be in favor of excluding the export duties from the divisible pool. It will thus appear that the demand for the allotment of a portion of the export duties to the units has been voiced even at the time of the framing of the Constitution. It will be only reasonable if the proceeds from the export and customs duties also are distributed between the Union and the states. These are the duties which yield considerable revenue, and with increased economic growth under the 5-year plans, the yield from the customs and export duties will also increase. There is no reason why the state should not have a share in those two duties. A suggestion has been made that customs duty may be transferred to the states. In the interests of interstate trade and trade with foreign countries, it's not desirable to transfer customs duty to the state list. We therefore recommend that the export and customs duties should be compulsorily distributed between the Union and the states. Tax on the capital value of assets. The other tax levied and appropriated by the Union in its entirety is tax on the capital value of the assets exclusive of agricultural land. Although Entry 86 is specific and excludes agricultural lands from its purview, Parliament has recently provided for the levy of wealth tax on agricultural assets also. The tax on the capital value of assets is somewhat similar to estate duty and succession duty. Estate and succession duties, though levied and collected by the Union, are to be entirely appropriated by the states. The estate duty on immovable property is being allocated to the states on the basis of location. This is in accordance with the recommendation of the Second Finance Commission, which has been followed by the 3 subsequent commissions. We would recommend that the taxes mentioned in Entry 86 of the Union list should be made divisible. Taxes included in the Provincial Field under the 1935 Act, but included in the Union Field under the Constitution. We have so far dealt with taxes which are levied and collected by the Union, and the entire proceeds whereof are appropriated by it exclusively. As indicated earlier in this chapter, The Union list contains at least 4 entries which under 1935 Act were in the Provincial Field. They are entries 84, 90, 92 and 92A. In the chapter dealing with distribution of legislative powers, we have dealt with the levy of excise duties on medicinal and toilet preparations containing alcohol under entry 84. The reason adduced at the time of the Constitution was drafted for putting this item in the Union list cannot be said to be conclusive, nor is it convincing. Excise duties on alcoholic liquors for human consumption are leviable by the state. There seems to be no justification for the exclusion of excise duties on medicinal and toilet preparations containing alcohol from the purview of the states. This item may well be transferred to the state list. Entry 90 relates to taxes other than stamp duties on transactions in stock exchanges and futures markets. We have already pointed out in the chapter relating to distribution of legislative powers that stock exchanges and futures markets were under the 1935 Act treated as falling within entry 27 of the provincial list. Under the Government of India Act 1935, levy of sales tax on newspapers and advertisements in them was exclusively in the provincial field. The two levies under entries 90 and 92 are dealt with in another place in this chapter. Entry 92A is consequent on clauses 2 and 3 of Article 286. In pursuance of the power conferred by the entry and the article mentioned above, Parliament has enacted the Central Sales Tax Act 1956, Central Act 74 of 1956, according to Section 9 of the Central Act 74 of 1956. The tax payable by any dealer under that Act on sales of goods effected by him in the course of interstate trade or commerce is levied and collected by the Government of India, but the proceeds in any financial year of any tax, including any penalty levied and collected under the Act in any state, should be assigned to that state and retained by it. The levy is on transactions taking place in the course of interstate trade or commerce. No modification of either the constitutional provision or the central act bearing on the subject is necessary. The present arrangement may continue. We have so far dealt with only one particular aspect of entries 84, 90, 92 and 92A of the Union list, that is, the justification or otherwise for their continued retention in the Union list. In dealing with entry 84, we have confined ourselves only to one particular part of the entry, namely levy of excise duties on medicinal and toilet preparations containing alcohol. The above-mentioned entries have to be considered from another angle also. Whereas excise duties on medicinal and toilet preparations containing alcohol mentioned in entry 84 and stamp duties mentioned in entry 91 are entirely appropriated by the state, the other duties of excise mentioned in entry 84 are not compulsorily divisible between the Union and the states, and their sharing is, under Article 272, dependent on the will of the Parliament expressed through law. The taxes mentioned in entries 90, 92 and 92A and those mentioned in entries 87, 88 and 89 form one class in that the net proceeds of those taxes in any financial year are, under Article 269, assigned in their entirety to the states to be distributed among them. Thus, we have to consider the issue in relation to Articles 272 and 269. Excise duties. Duties of excise on tobacco and other goods manufactured or produced in India leviable under entry 84, subject to the exceptions specified in that entry, may, if Parliament by law so provides, be shared between the Union and the states under Article 272. The Expert Committee on the Financial Provisions to be incorporated in the Constitution recommend that 50% of the net proceeds of the excise duty on tobacco should be distributed to the units. This recommendation of the Expert Committee was not accepted. Accordingly, the drafting committee made a provision in the draft constitution for the permissive sharing of excise duties with the states. While commenting on the draft article, Thiru B. Gopala Reddy suggested the transfer of all duties of excise from the Union to the state list, and Thiruvalargal K. Santhanam and M. Ananthasayanam Iyengar and Thirumadi Durgabai suggested that the whole of the Union duties of excise, although levied and collected by the Union, should be paid to the states concerned. When this article was considered by the Constituent Assembly, the then Premier of Assam, Thiru Gopinath Bardolai, desired that the sharing of the proceeds contemplated in the provision should be made obligatory and not dependent on legislation by Parliament. Two other members supported this view, but the provision was adopted in the present form. It will thus appear that the demand that the sharing of the excise duties under Article 272 should be mandatory and not permissive has been put forward even at the earliest stages. The Finance Commissions have recommended a more extensive use of Article 272 for affording assistance to the states. The first three Finance Commissions had taken the view that having regard to the growing requirements of funds by the states for developmental and other essential services, recourse to permissive sharing contemplated under Article 272 was not only justified but even necessary. The Fourth Commission endorsed this view. In a supplementary note, the chairman of the Fourth Commission has referred to the possibility of making a constitutional amendment placing the excise duties on the same footing as income tax, that is, making the excise duties also compulsorily divisible between the Union and the states. The Fifth Commission has dealt with this point in paragraph 43 at page number 31 of its report. The Commission states that the sharing of Union excise duties enables both the Union and the states to participate in what elasticity the divided taxes possess, and that the payment of grants under Article 275 may be required to a lesser extent. It will be seen from the reports of the 5 Finance Commissions that the number of commodities subject to excise duties has been on the increase. The share of the states in the excise duties also has been increased by successive Finance Commissions. But special excise duties and regulatory duties and cesses are excluded from the divisible pool. The Fifth Finance Commission has recommended the division of special excise duties for the years 1972-73 and 1973-74. The Fourth and the Fifth Finance Commissions have stated that special excise duties should not be the rule but the exception. Regulatory excise duties and cesses have always been placed outside the divisible pool. Excise duties are more in the nature of sales tax, and there is no reason why special and regulatory excise duties should be excluded from the share of the states. Thiru G.S. Bhattacharya, speaking at the Indian Parliamentary Association Symposium on Center-States Relations, held in New Delhi on the 3rd of May 1970, has stated that in his opinion, the excise duties should be distributed compulsorily among the states. Answers to this question received by the committee suggest that the distribution of excise duties among the states and the Union should be made mandatory. We recommend that Article 272 may be amended so as to make the division compulsory in order that the excise duties, special, regulatory, or otherwise, may all be shared with the states. Additional duties of excise is a related subject. This is being levied under the Additional Duties of Excise, Goods of Special Importance Act 1957, Central Act 58 of 1957, according to the proviso to paragraph 2 of the second schedule to that act. No sum will be payable to any state under the act if sales tax is levied in that state on the goods concerned. This arrangement, whereby the states agreed to surrender sales taxes and substitute them by additional excise duties levied by the Union, was taken at a meeting of the National Development Council. Thiru K. Santhanam, in one of his lectures on Union-State relations in India, delivered in March 1959 under the auspices of the Indian Institute of Public Administration, has described the manner in which the National Development Council made this decision. He says, quote, I believe the decision to surrender these taxes and substitute them by additional excise duties was taken at a single sitting of the National Development Council, at which many of the chief ministers had not even fully consulted their own cabinets. Actual facts are not known as they are necessarily state secrets. But this is the kind of impression which the public have got, because no attempt was made to canvass the opinion of the state legislatures, and there was no discussion in the press. Unquote. The Fourth Finance Commission has described this scheme of centrally levied additional duties of excise in replacement of states' sales taxes combined with distribution scheme as essentially in the nature of a tax rental agreement. The Fifth Finance Commission has referred to the general opposition of the states to the levy of additional duties of excise and has stated that there is no scope for extending the arrangements to other items of duties in the foreseeable future. It has also stated that it would not be desirable to continue the scheme unless the Union and the states agree to its continuance with suitable modifications. It has suggested the initiation of discussions in this behalf. It is reported in the Hindu dated the 12th of June 1970 that all the chief ministers have at a meeting of the National Development Council demanded the abolition of additional excise duty and reimposition of sales tax, and that the matter is being examined by a committee of all chief ministers with the deputy chairman of the Planning Commission as the chairman of the committee. The same report quotes Thiru P.C. Sethi, the then Union Minister of State for Finance, as saying that if any agreed formula was not evolved and the chief ministers insisted on the imposition of sales tax, the centre would not go against the proposal. Subsequently, the Committee of Chief Ministers is reported to have agreed to the continuance of the levy of the additional excise duties in lieu of the sales tax, subject to the condition that the rate should be increased to 10.8%. Wide, the Hindu, dated the 29th December 1970. Even if additional excise duties are abolished and states are permitted to reimpose sales tax on the goods in question, the levy by the states will be subject to restrictions. Under Section 15 of the Central Sales Tax Act 1956, Central Act 74 of 1956, the taxes payable under the sales tax law of a state in respect of a sale or purchase of declared goods even inside the state, should not exceed 3% of the price, and such tax should not be levied at more than one stage. Section 14 of the Act specifies the declared goods, and they include coal, cotton, cotton fabrics, hides and skins, iron and steel, jute, sugar, tobacco, silk fabrics, etc. In other words, even sales or purchases taking place within a state will be subject to the restrictions mentioned above. Thus, the tax both on interstate sales as well as intrastate sales has to conform to the conditions stipulated in the Central Act of 1956. If the states are to get the full benefit of the abolition of the additional excise duties, it's necessary that these restrictions should be removed. Sections 14 and 15 of the Central Act are relatable to clauses 2 and 3 of Article 286 of the Constitution. Those clauses empower Parliament to formulate by law principles for determining when a sale or purchase of goods takes place in any of the ways mentioned in Clause 1 of the article. Parliament is also empowered by law to declare goods to be of special importance in interstate trade or commerce, and once this declaration is made, the sales tax law of a state will be subject to such restrictions and conditions in regard to the system of levy, rates, and other incidents of the tax as Parliament by law specifies. Sales tax is the only source of revenue available to the states, which can be said to be an expanding one. The power of Parliament under Clause 3 of the article should not be exercised except in consultation with the states, nor should any fresh declaration be made under the clause without such consultation. We have separately recommended the setting up of the Interstate Council charged with the function of scrutinizing all bills affecting one or more states before their introduction in Parliament. This recommendation, if implemented, will secure the object behind our recommendation relating to Article 286(3). The chairman of the Fourth Finance Commission, in his supplementary note, has referred to the representations made to the Commission to the effect that sales tax on a number of commodities should be substituted by additional excise duties on the ground that this would simplify the problem of collection. He has also stated that these courts may not find favor with the states. In that context, he has referred to the view that if by an amendment of the Constitution all excise duties are made shareable on an obligatory basis, the states might agree to the merger of sales tax and excise duties. Taxes levied and collected by the Union but assigned to the states. We may now take up the duties and taxes leviable under entries 87, 88, 89, 90, 92, and 92A. These duties and taxes are, under Article 269, levied and collected by the Government of India but are assigned to the states. This article corresponds to Section 137 of the Government of India Act 1935. The Joint Parliamentary Committee stated that Section 137 was necessary for securing uniformity in the rate of tax. These levies are really sources of state revenue, but they have been assigned to the Union list in order that there may be uniformity of law regarding their levy, rates, and incidents and collection. Of the items mentioned in Article 269, only two levies are currently in force. They are estate duty and taxes on the sale or purchase of goods in the course of interstate trade or commerce. The states have been complaining before the finance commissions that the assigned taxes mentioned in Article 269 have not been adequately exploited. The Fourth Finance Commission has referred to this complaint and has stated that each state illustrated this view with what it thought was an apt case. The Commission also refers to the feeling of some states that under the Constitution as it now stands, a temptation on the part of the Union government to neglect the state's needs is inescapable. It was also urged before the Commission that a general review of the intergovernmental financial relations, to be followed by constitutional amendment, if necessary, should be undertaken. The Commission again refers to a general feeling favoring more frequent consultations among the states and between the states and the Union in all matters of common financial interest. The study team appointed by the Administrative Reforms Commission to go into center-state relationships has suggested in 1967 a comprehensive examination of the possibility of exploiting the taxes mentioned in Article 269 and the repercussions that they are likely to have on the country's economy. It recommended that entrustment of this examination to a Finance Inquiry Commission or the next Finance Commission. The Fifth Finance Commission was requested to make recommendations as to the scope for raising revenue from the taxes and duties mentioned in Article 269, and the Commission has in its report devoted an entire chapter to this question. It may be advantageous to examine in the light of recommendations of the Fifth Finance Commission, hereafter in this chapter referred to as the Commission, on this topic, the feasibility of levying the taxes mentioned in Article 269 other than those which are already being levied.